All right, so people should be coming in now. So I might give it till maybe 2:03 or something, and then we'll get going.
Sure.
All right, I think we're ready to get going. Got a number of people in already, and I think a couple of people more will flow in as we go along. But thank you. I'll kick it off now. So thank you everyone for signing in. This is the first event the Monash Energy Club is having this year. So this is our inaugural event for 2020, our inaugural COVID event. We also had to make some changes in short time frames, but I think we pulled through. We've got a number of other events coming up during the semester, as well as I think unique things like launching a podcast, and we're also in the midst of planning our Clean Clubs initiative, which is to try and improve the energy emissions and efficiency of all clubs and societies at Monash. So keep an eye on the newsletters and websites for that. But I'll jump straight into it. Today I'm joined by Graham Bethune and Guillaume Roger. Graham is the CEO and founder of Energy Quest, a energy strategy and analytics company focusing on the energy industry with a particular expertise in oil and gas in Australia. And Guillaume is the Associate Director of the Monash Energy Institute, as well as a Associate Professor at Monash University and the founder of the Australian Electricity Market Initiative. So we will be doing Q&As today. So if you look in the top right of your screen, you should see a Q&A function. Just chuck your your questions in there as we go along, and then Brian and I will go through them at the last 15 to 20 minutes. And either Brian's going to ask them on your behalf, or if we can, we might try and give you permission to ask them yourself, depending on what Zoom allows. But I'll jump to Graham. So Graham, if you can tell us a little bit about yourself, about Energy Quest, and why you saw the need to found Energy Quest.
Right, thanks Alex, and thanks for the opportunity to be involved here today. It's a terrific thing to do. You know, I'm a Monash economics graduate, but I graduated a long time ago from Monash. And then I spent quite a long time in working for governments and in the banking industry. So I was a very late joiner of the energy industry, actually in my mid-40s. With an Australian oil and gas company called Santos. I was there for about 10 years and then left to start Energy Quest. The reason for doing that was that there was a clear gap in basic data about Australian energy, particularly about oil and gas and electricity to a lesser extent. So I could see a need there for the kind of data that I would have been able to use when I was at Santos. So we went, my wife and I went and set this up, and we've been going for about 15 years now, and it's endlessly interesting. So there's every day there's something new or a new set of data to analyze.
Okay, brilliant. I didn't know it was actually I didn't know it was you and your wife. That's not a LinkedIn page. So who are some of your clients? Who do you work with?
Oh, most Australian energy buyers and sellers and governments. So every Australian government is a client. Major energy buyers like Origin, AGL, Energy Australia, Snowy Hydro, and energy producers like Woodside, Origin Energy, Santos, ExxonMobil, Shell, and so it goes on. So it's about 80 or 90 clients like that.
Oh, wow. Okay. So I'm hoping that you can give us a bit of insights into the economics behind the oil and gas industry today. Guillaume, so you're a researcher at Monash and you're a founder as well of your own research projects. Could you tell us about the research that you do at Monash and about the Australian Electricity Market Initiative?
Yeah, absolutely. Well, thanks, Alex. First of all, let me thank you for inviting me to this, and congratulate you also for this initiative. I think it's awesome to see active students on and off campus at all times. So, as you mentioned, I'm an associate professor of economics at Monash, and my main job has been to set up this initiative that we tongue-in-cheek labeled the Australian Electricity Market Initiative. This was in fact at the behest of the Dean, so it's not just my little pet project, but the Dean is very much involved and invested in this. There's a bunch of us economists interested very directly in better understanding the electricity market. That market is undergoing profound transformation as Australia transitions by hook or by crook away from fossil fuel generation to renewable generation. So it's pretty clear to all of you students of energy that those energy sources have very different technical characteristics, and so that leads to much less obvious economic implications on electricity markets. So it's those implications that we try to understand in some more detail. And so as part of that, as I said, the Dean is behind us, and we just hired our first postdoc researcher, and we hope to add on to this little team. So I'm also an associate director of the Monash Energy Institute, as you mentioned. Many of you may know this institute at the university. It's an interdisciplinary research center with multiple research interests that range from electrical engineering, IT, economics, but also even design. So sometimes we think, for example, of the interaction between the interface of energy and consumers. And so finally, I also recently joined the board of what's called the Grid Innovation Hub at Monash, which brings together a bunch of academics and industry partners to work on applied research on the grid. So we're concerned about questions of grid stability, frequency control, voltage control, but also pricing on a congested network. Right? So these are things that are a little bit less obvious to people involved in energy, but are nonetheless important in market design.
All right, brilliant. All right, thank you, Guillaume. So we're going to jump straight into it. I think it'd be useful for us to first outline what the energy market actually looks like before we dive into oil and gas. Guillaume, could you provide us a little bit of an overview as to sort of what the market looks like, how we use electricity, and how energy or oil ties into electricity and energy consumption?
Yeah, so there's a very easy answer to that. I think Graham would agree with me that oil and electricity have very little to do with each other, as a matter of fact. As you pointed out elsewhere, we don't use oil for generation of electricity, except when you use a diesel generator, but you do that very much as a last resort. So you see that in remote communities or in mining locations, but otherwise we don't use oil for electricity production. So we use either coal, gas, or other sources of energy, which are the renewable energies like the sun and the wind for the most part. So that's broadly the fuels that we use for producing electricity. I guess what we see at present is a significant drop across any source of energy, any kind of energy, significant drop in demand. So it's a drop in demand for electricity because we're confined at home and there's a lot of industrial processes that have been put on hold. There's a drop for gas for pretty much the same reasons. And there's a significant drop in oil demand as well because we don't drive and we don't fly. And also oil enters industrial production as well. So that's the landscape today, I think.
Yeah, we've seen a big drop in oil demand, obviously. Graham, would you agree with Guillaume's statements that we're seeing a drop in demand for LNG as well? Oh, yeah, you're muted.
Yeah, I mean, at the moment, Australia seems to be a bit of a standout. So certainly oil demand has fallen significantly. And if you look at things that have been said by, say, Caltex or Viva Energy, who are the main retailers in Australia, certainly they're all talking about a big drop in demand, and particularly for aviation fuel. For electricity, though, it's there's much less evidence so far. In April, electricity generation in the national energy market, so that's the East Coast, only fell by about 2%, which was the same in the months before, and it's highly dependent on the weather. Also, in relation to gas, there hasn't really been any discernible fall domestically in gas demand or in Australian gas exports. So Australian gas exports are, which is LNG, liquefied natural gas, have been holding up very well. So in that context, Australia seems to be different to a lot of other countries, certainly in major European countries like Italy, Spain, the UK. You've had falls in certainly in gas demand of about 10 to 20%, and also in Southeast Asia you have too. But so far they're not that apparent in Australia. We keep saying nothing has happened yet, implying that it's just around the corner, but the corner seems to be getting further and further away.
Okay, well, that's definitely interesting to hear. A little bit of disagreement between the two. Now, Kate Tyler from Shell was third panelist, but obviously living in Houston, it's a bit difficult to get all three of us in one room, one virtual room together at the same time. So I'm hoping that some of our participants or attendees have watched the interview that I did a couple of days ago with Kate Tyler. Based off that interview, it really seemed that Shell is, I guess, optimistic for the future, and that they're going to be hit financially, but things aren't going to have a long-term detriment to their company. And one of the things that they did was cut their dividends by 66%. I guess I'd like to open it up to the floor. Is this one decision of cutting dividends enough to float them through to the end of COVID? Or do you think they'll have to make more changes to their business in the near future? I might open it up to Graham first of all.
Okay. I mean, Shell is one of the most financially robust companies in the world. And not only do they have a very strong balance sheet, but they also have access to capital markets, both to borrow and to raise equity. So I don't have any doubt that they'll be able to work their way through this pretty easily. It was quite unusual for them to cut the dividend, but it's probably a prudent thing, and that's happening all over the world. Dividends have been cut in Australian banks. Dividends are all being cut as well. But I think they'll come out the other side. What is happening very much so is there is a pullback in sanctioning new projects. So companies like Shell, new oil projects or gas projects or renewables for that matter too, under the current circumstances, you're seeing them pushing them back. You know, we were going to announce the go-ahead next month or this year, but now suddenly we'll leave it for a year or two and wait till things settle down a bit.
Yeah, I think they have committed to still invest as much as they were before into their new energy projects. But I think, Guillaume, did you have anything to add regarding the investment into new energy projects, or?
So not very much. I think I very much concur with what Graham was saying. This, as long as these firms have access to capital markets, they can resort to that to weather the storm. Cutting dividends is the prudent thing to do. It's like you trying to spend a bit less money than you otherwise would, just because there's a bit more uncertainty in the world. Cutting dividends is not enough, I would imagine, for them to weather a storm. They will have to go to those capital markets in one way, shape, or form. On the other hand, the oil and the gas on which they have production rights is not going anywhere. So, they can always get out of the ground in a year or two if the demand is not panting up in the very near future. So I think they'll be fine. There's not a question, I think, for the broader sector, which is there's a whole heap of smaller players. These smaller players may not be as financially secure as Shell, for example. And so will they hit the wall? Well, some of them definitely will, I think.
Yeah, well, I guess the United States is in a bit of a unique position with their shale oil. As Kate was saying, a lot of oil production in the United States is governed by small enterprises, and we've already seen some of those enterprises go bankrupt.
Yeah, absolutely, and that'll continue. There's no doubt. So when it comes to those alternative investments, I've heard the numbers that she mentioned this morning, $1 or $2 billion a year. For a firm like Shell, this is not very, very much. So maybe they will continue. Maybe they'll decide at some point in a month from now that the crisis is really a little bit hurtful and they'll cut them then. But these are not large numbers for a firm of that size.
Okay. So then continuing on the topic of oil, we've seen it come back up to around $25 a barrel, or maybe actually up to 30 now. So I think this has had to do with a lot of huge cuts in oil production. But with demand still being as low as it is, with countries still being on lockdown, do you expect to see this price in oil flatline at this point, or continue to rise, or do you think we'll see another drop as we did earlier in the year? I'll take that one to, I guess, Graham. You maybe know a bit about that.
Okay. Actually, one thing that's important to remember is that there are different benchmarks for oil, and the two most common ones is a benchmark called Brent, which is based on oil from the North Sea in Europe, and the other benchmark is called WTI, West Texas Intermediate, which is a US oil, which isn't actually from Texas, but it's based in Cushing, Oklahoma. And those oils have different specifications, so they always tend to trade at different prices. And WTI trades at a lower price than Brent. It's currently about $5 US lower. So when we talk about oil prices, we normally talk about Brent. And you're right, Alex. Prices even of Brent fell significantly and have actually since been increasing, so up to a bit over $30 a barrel last night. Off the back of the International Energy Agency yesterday put out their monthly oil report, which showed that demand hadn't fallen quite as much as they were forecasting, and supply had actually probably fallen more than they were forecasting. So that gave the market some confidence, and they pushed the oil price up again. We're assuming an average oil price of about $30 through to the end of this year, getting up to around $40 next year. That's still relatively low. Our long-term oil price assumption is about $65, but we do see a gradual recovery.
There has been I guess a question as to, with production being cut so dramatically, when demand does spike again once lockdowns ended, will we see another I guess shortage of oil? Will all these oil reserves be dried up, and will it take a significant amount of time for oil production to restart?
Well, there's still a huge amount of oil production going on, and it really depends on how long it takes demand to reset. I noticed that there was a report from the International Aviation Association saying that they don't expect demand for air travel to get back up to previous levels until around 2023, for example. Aviation is a huge user of oil, so we don't expect. I think it'll take time for demand to gradually increase, and who knows? I mean, supply may overshoot on the low side, but the oil price is always unpredictable. But it does seem more likely to go up now than down further.
Guillaume, the electricity market isn't exactly new to negative prices. We see them bidding in quite often at below zero. Is there anything that you think you've learned from watching the electricity market that you think could be useful?
Well, I've learned that economics is very useful, Alex, because, you know, as you mentioned, we see negative prices in electricity, for example, from time to time. And so it's not really that surprising to some economists that we may see negative prices on other markets for other commodities, right? So in this instance, I'm making reference to this little episode from 2 or 3 weeks ago when we saw oil prices go negative. In fact, you know, in economics, the short side of the market is the side that gets paid, and the short side of the market this time was storage, and so storage was very, very valuable, and oil was not for a brief episode of time. And so storage got paid. So lo and behold, of course, we found a bit more storage, which is a little harder to get to, a little harder to find, but it was there. And so in the end, they found space to store the oil. So now since then, we've reverted to sort of more normal price levels. But I think maybe to complement Graham's answer, storage is a big question mark at the moment in the oil market. And so the question is, how fast do we run out of storage space if we have this persisting slump in demand, right? So at this point, the forecast was we'll run out of storage around June or July. And so then if the producers are unable to cut production further, then the question is, what's the price of oil in July when we really have essentially no use for it? And so, you know, I wish I had a crystal ball. I don't, but I believe that this is it's going to be a turning point if we ever get there.
Okay. And we've seen that production cuts have been, I think, northward of 10 million barrels a day from the OPEC countries. Would you expect to see production cuts continue? Or, you know, our oil reserves are getting, I think as Guillaume was saying, as full as they always can be. Will we have to see further production cuts?
Well, I mean, we are seeing cuts in production just naturally, and particularly at the moment, the IEA pointed out that there were quite substantial cuts happening outside OPEC. So that in particular in the US, so I think that there will just naturally be significant cuts in addition to the OPEC ones, and the OPEC cuts, of course, include Russia as well, which is a major oil producer. So we are seeing demand isn't as bad as people thought, and supply is falling a bit faster than they thought.
Yeah, well, I guess moving on then to OPEC. As we've mentioned it, I personally have had some thoughts about whether oil is being governed correctly. Is OPEC still as relevant as it was before? You know, US isn't part of it. He's saying Russia isn't part of it, and there's been countries like Mexico who weren't following the OPEC production cuts, and production cuts are voluntary. Is OPEC still as relevant as it used to be, or can we see something else come into its place?
Well, monopolists would always like to have control of a market, but what's been happening with OPEC is that they've been losing market share over time. Their current market share is about 41%. So 41% is hardly dominant in the entire oil market. And one of the reasons they've been losing market share is because of the increase in oil production in the US, but also in other countries as well. So OPEC have had this dilemma about, do they try to control prices and maintain them at high levels and therefore encourage competitors like those in the US, or do they not do that? Do they keep prices low and then suffer themselves? So that's the kind of perpetual dilemma that they've got. They've brought Russia in as well with OPEC, so that increases their market share to about 54%. So it's still important, but I mean, the real competition is US shale oil. They would say that there are all these Americans losing money on shale and destabilising the world oil market. You know, a dominant existing supplier, potential monopolist would always complain about that. Anyway, but they've got this. I mean, there's this perpetual dilemma that they've got. So in 2014, they decided not to have cuts, but just when there was pressure on them to cut, and decided just to let the market rip, in the belief that would drive the US out of the market. It didn't work. All it did was reduce their prices. So then they brought in cuts. And then we've been through a bit of the same thing again now. Back at the beginning of March, well, actually, the Saudis were looking at cutting, but the Russians had a different view in mind. So then prices plunged. That gave them both a shock. And brought them both back to the table. But even at current prices of around $30 for Brent or $25 for WTI, I mean, those prices are really too low for a lot of US oil production. So it's really economic game theory, which I'm sure Guillaume can comment on there.
Yeah, Guillaume, was there anything you'd like to add there? I think Graham gave a good overview of OPEC.
Yeah, so I think it was a very good description. So thanks, Graham, for that. What we also see is, as prices drop, those marginal shale producers tend to exit the market or stop producing. Right? It's a lot easier, in fact, technically, for them to stop production than it is to turn off a well, and so they'll be the first one to cut production. So then the question is, as US producers start exiting the market, that gives OPEC relatively more power on the remaining production, and surely they would, you know, as Graham pointed out, they're if not the monopolies, they're the dominant player, even though they're not as big as they used to be. They still are the dominant player in this market, and so they'll seek to exercise that dominance by cutting a little bit on the production to see prices go up a little bit. I would imagine, at least, you know, at this kind of very, very low price level, I think this is what I would anticipate. But I would say, you know, it's very tempting to write off OPEC because, and Graham made the case very cogently, that OPEC is not as powerful as it used to be. Right? We found alternative sources of oil and gas, which sort of freed us a little bit from the shackles of OPEC. But I think as long as you have a big producer like Saudi Arabia that controls effectively OPEC, and that makes OPEC relevant. And so I think it'd be a bit premature to write it off completely. And I think for them to become a thing of the past, would have to see a significant player, so maybe something like Venezuela, which is said to have the largest oil reserves in the world, to finally come into play. But Venezuela is a basket case today, and so we're a long way away from that, I think.
If I can just comment that the problem OPEC has always had is also cheating.
Yes, it's a very unstable cartel. That's right.
Yeah. So if the Saudis are wearing all this pain, then there's a strong incentive for another country like Equatorial Guinea or somewhere like that not to actually cut as much as they claimed they were going to cut, because there isn't good visibility on precisely how much everybody is producing anyway. In recent years, the OPEC members seem to have been more disciplined than they used to be, but that's also a problem. And one of the reasons for that is a lot of the OPEC members, not so much Saudi, but many of them, like Venezuela, for example, need very, very high prices for their internal budgetary reasons. So if they can't get those, then that's a real problem for them. So that makes it hard to keep things together. The Russians also have an argument, I suppose, within OPEC that if you keep prices high, all you're doing is favouring, from a geopolitical comment, that all you're doing is favouring the US, and the US is imposing sanctions on Russia, and imposing sanctions on Iran, and imposing sanctions on Venezuela. So you've got three major oil producers there. So keep prices high, then the US can keep producing, and they don't need oil from Russia or Iran or Venezuela. And all of that. So that's also a dilemma for them. They don't want to give it's sort of from a geopolitical point of view. They'd rather not have the US in a position where it's energy self-sufficient, really, but rather a position where they are reliant on OPEC producers in Russia.
Yeah. All right. Well, I might move on then to the oil companies themselves. So we saw from Kate that they're continuing to invest $1 to $2 billion into their new energy investments. And as Guillaume says, $1 to $2 billion isn't exactly a lot for a big oil company such as Shell. But with COVID and the negative oil prices, it's potential that we've seen these oil companies become spooked a little bit by oil, and will we see them investing more into new energy technologies or having radical changes to their energy portfolios in the future? I might chuck that to Guillaume.
Well, that's a very tricky question, I would imagine. So right now, my sort of first order reaction as an economist is, yes, oil prices are low. That means gasoline is very cheap. And that means I can keep on driving my internal combustion engine car for as long as I want, right? I don't need to contemplate switching to anything that looks like an electric vehicle anytime soon because oil is so cheap. So I would imagine that this would slow down the transition from internal combustion to electric vehicles. It would slow down the transition from, say, gas generation to other forms of electricity generation more broadly. And so it would make those alternative investments less attractive, right? It would give a new lease on life for hydrocarbon producers for at least a few years. Not forever, but maybe for the very near future.
Are we likely to see any changes from, in terms of the energy market? And I guess I'm moving on towards the electricity market. In terms of wholesale prices, are we expecting to see these oil companies shift a little bit more from oil into electricity?
To do what exactly? So let's not be confused here, because oil is not used for the production of electricity. So anything that's to do with generating electricity is almost orthogonal to oil.
Yes, but we have seen in the, I guess, recent past that a lot of these big oil players are starting to move into as producing electricity as well. So in Queensland, I think BP has just built one of their first large solar farms. I guess my question is, are we likely to see more investment into like renewables? Because just in the future, are we likely to see more investment into renewables or these other electricity technologies?
We're certainly seeing more investment into electricity by oil and gas companies. So Shell in Australia now has an arm called Shell Energy, which sells electricity on the East Coast, and they bought a major Australian electricity generator called ERM fairly recently, and then just the other day, the French company Total registered Total Gas and Power Australia, So they're doing the same thing, and so that'll be conventional electricity, but plus also renewable. So I think that they've particularly the European companies have got a long-term focus and plan, and sort of the vagaries of oil prices are unlikely to really upset that. What's probably more important is EU environmental policy, and in particular in the EU, you've got the Green Deal, which the EU is largely committed to, and that's really influencing the behaviours and incentives of at least European-based oil and gas companies, and not only in Europe but also in other places they operate, like Australia.
Mm.
Yes, I would agree with that. So you mentioned investments into alternative energy sources, and I think Kate mentioned that also in her interview. And I think that they've been the hydrocarbon producers in general, because not just oil, it's all gas producers, have been contemplating those investments for some time now. So this is, independent of COVID, independent of oil price drops. I think they see the dark at the end of the tunnel. There will be a future in which we don't consume hydrocarbon, or at least we don't consume hydrocarbon in such a significant way for the purpose of energy production and transportation. So it's pretty clear, but this is driven very much, as Graham was saying, by emission policy and the fact that they are told by regulators, but they also are told by their own investors that they have to contain emission production. And so, for example, Woodside is now very much seeking to promote hydrogen as a new fuel, as an alternative fuel to the gas they produce, right? Because they know, and have been told in no uncertain terms by some of their investors, that they have to curb emission generation. And the only way you do that is that you stop burning hydrocarbons.
So are we likely to see sort of, not anytime soon, but a full shift away from oil? But do we still, I think oil only makes up 50% of, or sorry, petrol only makes up to 50% of the oil we consume. But are we likely to see substitutes in the near future that completely rid us of dependence on oil?
So I think you're asking me to put out my crystal ball, which I still don't have. So it's not completely to answer, but I think it's very clear if you look at the mere fact that we start driving electric vehicles, and a firm like Woodside, but Woodside is not the only one, are taking hydrogen as a very serious alternative fuel. So I don't think they make those investments lightly. And so if they, as the hydrocarbon producers, decide that there may not be a very long future in producing hydrocarbon, then I think we should pay attention to this. We should take notice of this. And I've got little data in terms of much of transportation. I can't speak for aviation yet, but something for terrestrial vehicles, there's no doubt that we'll see these phased out very fast.
Graham, would you have anything to add there on the long-term sustainability of oil? Sure.
I mean, in many ways, oil is a fantastic fuel, just in terms of its physical characteristics, its energy density. I mean, it doesn't weigh as much as coal. In terms of volume, you can get a lot of energy in a much smaller volume than you can with gas or something else. So it's fantastic. It makes plastics as well. And it also doesn't use up a lot of land. Probably most people on this call wouldn't have ever seen an oil well. A lot of oil is produced offshore or in the middle of desert, so it sort of keeps out of the way, doesn't compete for farmland or things like that. But at the same time, it has increasingly undesirable characteristics as well. And one of those is clearly the emissions. I mean, currently nearly 20% of Australian emissions come from transport. So that's not all oil production, but just from transport. And if oil demand keeps going up at the current kind of rate, those emissions will almost double by 2050. So you get a lot of focus on coal in the kind of emissions debate, but you get almost no or very much less focus on oil. So, but oil, Australia also is a disproportionately large user of oil compared to the sort of global average, partly because we're a big country. But it also creates air pollution. That's partly dealt with by emission standards, but that's bad. And also in plastics. Most of Australia's oil now is imported from Singapore or Japan or Korea. So there are security risks there too. Australia imports 1 million barrels of oil a day. So that which is a huge quantity. There haven't been any disruptions on that due to COVID, but it's certainly a risk. It's Australia's second biggest import, and a lot of crude oil producers around the world. Countries have pretty unsavoury reputations too, don't they? And tend to be fairly corrupt. So I mean, you know, there are all these sort of dark downsides as well. So there are lots of good reasons for, particularly I think for Australia, trying to reduce its oil consumption, and there are lots of ways of doing that. Some of the ones that Guillaume just mentioned, but there's also emission standards. There's also just the price of petrol. I mean, petrol's about 90 cents a litre now, about half of which is tax. So it's very cheap. Now would actually be a good time for the governments to increase tax on fuel to make use more efficient. I mean, we waste huge amounts of fuel every day by cars just parked in freeways waiting to move on. And there are lots and lots of ways you can reduce it. And sort of Monash students in areas like, in just about all areas. I mean, it's a terrific time to just work on these things and as part of the revolution.
Well, I guess that leads us into what will be my last question. So all the attendees, if you want to get your Q&As ready, so we can go straight into that. But I think it's on everyone's minds at the moment with the recession going on, as to the future careers of Monash graduates. And maybe you could give us a little bit of insight into what areas of the energy market we should really be looking into as a career, especially in a market like this. Perhaps Graham, you want to take that off?
You know, as I say, I was a very late starter in the energy sector. In hindsight, I wish I'd started earlier. Actually, I would probably not focus on a particular kind of energy, but more focus on the kind of companies and the training that you would get. From that point of view, I mean, Shell, for example, would be a terrific place to start, or any of those large companies, partly for the training. Having Shell on your CV never hurt anybody, I don't think. That doesn't mean you have to work for one of the large companies forever. So then, I mean, the whole energy sector, including electricity, including renewables and new energy, is full of people who started their careers working for major existing energy companies, partly in oil and gas, but also in electricity for that matter too. People working for people like AGL or Origin or so forth. So a terrific area to be in. This is the energy transition. Energy transitions don't happen that often. So there are lots of opportunities out there. I would recommend starting with a company that will give you a good background, good training, and which will be then a good launching pad for the rest of your career.
All right. Well, thank you, Guillaume. Maybe you want to try and sweeten us towards the research side.
Well, always, but you know, the research is not for everybody. So, but for those of you who are interested, by all means, you know me now, so you can approach me, or you can ask Alex for my details. But a little bit more seriously, I want to second what Graham is saying. I think picking a good company that has some reputation and that can provide some training is always advisable. I think we are in a transition, and so it's a little bit important to think about who those companies are going to be that are going to be able to make this transition successfully. That's maybe one point of differentiation. The other thing is In this transition, you know, we mentioned hydrogen, for example. Is this real? Is this not real? I think it's quite speculative, but I think there's also enormous amount of effort that's been put into this. And so if students have some skills that they can devote to this, to understand how you effectively transform one source of energy into another that is more usable, because that's the name of the game here. That's something to bear in mind. And finally, I would encourage you to contemplate very much the electricity industry. It's undergoing significant transformation, and there'll be new skills required, which have not been prevalent in electricity in the past. So, for example, we use more people in IT now in electricity than we use electrical engineers. And so if you want to prepare yourself for a career in electricity, for example, then make sure you study IT. If you have studied IT, don't neglect electricity as being a potential outlet for your skills.
Yeah, I think Kate said the same thing. Don't go into Google, go into energy.
Exactly.
All right. Well, I'll open up to the questions now, and I'll chuck it to Brian, who will be our virtual mic holder. Brian, did you want to actually, I guess, start typing them now, because we'll go through them. We'll get through as many as we can. There's a couple there already, but keep typing them, and we'll try and get to them. So, Brian, did you want to take off?
Yep. So we have our first question from Roger. So his question is: the high petrol prices would be a driver for stronger uptake of electric vehicles. Do you think there will be a slowdown in uptake of electric vehicles with the low oil prices for the foreseeable future?
Certainly, for people who just try to do the economics, that would be the case. And we did a recent comparison of two kinds of BMWs, an i3, which is an electric vehicle, and an X1, which is a conventional vehicle. And certainly, even at somewhat higher oil prices, like around $1.50, the payback period was about 20 years for the electric vehicle. But I think initially, the take-up of electric vehicles is much more likely to be driven by other factors rather than just the straight economics. So, like by people who want to try it because it's new, people who want to, who believe that they should support it too for environmental reasons. So, and also you're getting a bigger, wider range now. You get in. It's not only, you're not limited to BMWs or Teslas, but I think you can also get good Hyundais, for example. So I think. That will keep happening. The big challenge is that cars are only around 40% or thereabouts of oil consumption, and so freight is incredibly important, and as are train, ships, and planes, and so it's a matter of looking at alternatives for those too. But yeah, I think electric vehicles will keep going.
Yeah, so I want to second that because I completely agree. In fact, I've got some colleagues at UC Davis in California who did a study of that, and that echoes very much what Graham was suggesting. The economics as of today don't really stack up to purchase an electric vehicle compared to an internal combustion engine. If you abstract from the fact that we don't price carbon emissions, but taking that as given, no one should be buying an electric vehicle based on the economics of it. But people do it, and they do it out of conviction more than anything. Environmental concerns and the like, which are very laudable, but it's not based on economics. And if it's not based on economics, then I think dropping oil prices is going to have no impact at all.
Okay, thank you for those. So our next question is for you, Guillaume. This is from Imer. So he asks, how do you see the blockchain revolutionizing the renewable energy sector in foreseeable future? Things like solar coins for participants who generate energy and sell them according to the neighborhood conditions.
Okay, so blockchain is only ever a device to keep track of information. So I guess the question has to do with, are we going to see something like distributed energy being bought and sold independently of, say, AGL or the other retailers? I presume that's the nature of the question. I'm not sure, but I'm going to run with this and answer that question, which I know how to understand. So there's an enormous interest in this, in what's called distributed energy resources. And so that means, roughly speaking, you have solar panels on your roof and you want to sell that power Right now, AGL gives you some rates, but maybe you can organize yourselves among your friends and your neighbors, and you have you trade electricity at some price that you agree on. So that's the premise of DER. I'm going to dissent compared to the majority view. A lot of people getting very excited about this, and I don't, for two reasons. The first reason is that usually you end up, as a consumer in your household, you end up wanting to sell your power when no one wants it. That is at 2 in the afternoon, when you're not home and your neighbors are not home, and the price of power is in fact very low. So you want to sell your power exactly when no one wants it and at a very low price. So that's unlikely to create a very successful market. The second part is that the problem with those distributed arrangements is that they do have an impact on the grid as a whole. So they do have an impact on grid stability. That's what economists call an externality. This is something that is not being internalized by those participants in the market that trade among themselves. And so that's very problematic for the market operator to control these trades and control the stability of the grid when these trades are essentially unseen by the market operator. So it's not clear that we should encourage this rather than trying to organize the markets in a more centralized fashion, but also in a more efficient fashion.
Okay, thank you for that answer, Guillaume. So we have our next question from Liam. He asks, what are your thoughts on the shutdown of the Viva Energy catalytic cracking unit? How significantly do you speculate this would affect the profitability of the company? Is this a bad sign for Viva Energy compared to other refineries based in Australia?
Well, there aren't that many refineries in Australia now. There are only 4. One owned by BP, one owned by Caltex, one by ExxonMobil, and one by Viva, which was the former Shell refinery. Yeah, I mean, I think all of the Australian refineries are sort of temporarily closing down units as a result of the fall in prices and the fall in demand. That doesn't. I'm not that familiar with that particular case. But the big issue is the sort of future viability of refining in Australia as opposed to importing. So on the one hand, the refineries in Singapore and Japan and Taiwan are much larger and much more efficient. On the other hand, they all involve sea voyages to Australia. So there's this continuing dilemma for the government, and in fact, recently the Angus Taylor has done a deal with the Americans to supply effectively an Australian emergency reserve, and I think there'll be further moves in that direction.
All right, I've got a question then. We saw Shell and a couple other big oil players announce their net zero targets by 2050. I guess when this comes from an oil company, people can be a little bit, I guess, apprehensive to take their word for it. What does this actually mean, and how effective are they? And is it at least a good step forward in the future in terms of oil companies cracking down on their emissions?
Well, it's certainly a good step forward, and most Australian, or most of the larger Australian companies like Woodside and Santos now have committed to net zero emissions, as for that matter as Qantas. I've got absolutely no idea how Qantas is going to achieve that. They produce 12 million tonnes a year of greenhouse gases, and can't really use any other kind of fuel other than jet fuel. So quite a lot. The only way practically that a lot of major consumers and producers can do this is by large-scale offsets. So then that takes you to planting trees or what's called carbon capture and storage, of which there is some in Australia. But beyond that, it's sort of difficult to see how it's going to happen in practice. But so 30 years between now and 2050, and as you said, Alex and Guillaume, I mean, there's a lot of financial pressure on them to do this. And they're all working hard on it, and I'm sure they'll come up with solutions. But in most cases, the actual roadmap to this destination. Isn't that clear?
Yeah.
Yeah, I tend to
Alright.
agree. There's not much I can add to that. I think this is completely true. I think, you know, if I'm not going to go into the details of that, but maybe the students should maybe do a project trying to understand what exactly is net zero, and you'll find that if you go into the details of it, not everybody in the world can be a net zero at once, right? Because usually you do that by buying excess energy from somewhere, but we can't be buying all excess energy at the same time, of course. Then there is no excess. So it's a little tricky, but I think it's also I do believe the intent nonetheless, and I get back to the point that they are under pressure from the investors. And that pressure is real. For example, I've got some friends who work in Macquarie Bank, and Macquarie Bank has a very clear interest in trying to find ways to find clean investments. Right? And they don't do that because it's nice. They do that because that's what investors want.
Mm. All right. Well, I think that sort of brings us to the end. If there's no more questions, I'll keep an eye on the Q&A, but if there's no more questions, then I'll wrap it up. Hold on, there is one. From Nur. Do you think a decrease in oil prices will discourage a low carbon transition in developing countries? The UN Secretary General said, we cannot allow the heavy and rising debt burden of developing countries to serve as a barrier to their ambition. Yeah. So will this, I guess this is coming back to oil prices aren't really related to electricity. But did either of you have anything you wanted to add to that?
It depends a lot on the developing country you're talking about. In countries that are oil producers, like our OPEC members, low oil prices affect them in all kinds of ways. And for example, Saudi is trying to look at a roadmap to beyond petroleum, and low oil prices don't help them in doing that, because they've got all these members of the royal family to fund, as well as trying to do other things as well. So I think certainly for those kind of countries, it will make life even more difficult. One of the things, the big fall in prices and COVID generally has also created enormous poverty in many underdeveloped countries. I was on a call the other night with people in South America, and they said, poverty levels in countries like Bolivia and Colombia and so forth have increased considerably. And what you've seen in all of those countries and is really governments having to step up even further to subsidise electricity prices, just because otherwise people can't afford it. Mm. So I think it's sort of inevitably that will put renewable developments in those countries on the back foot while people just try to survive.
Can I address two things to this? So the first one is, oil is used in many applications, not just in transportation. So even though we generate emissions by burning oil for all sorts of reasons, there's a lot of other products of oil that we use in everyday life, and that is not to be sneezed at completely. So we may find that we use oil for completely different purposes than just transportation, first of all. And second, I'm a little bit more optimistic than that, right? I think we can there is a chance for less developed countries that lead away from burning fossil fuel for the production of energy and for transportation. A little bit like, we don't see many phone lines in Africa, but there are a lot of cellular phones. So there's lots of mobile phones, and they made that leap without transitioning through landlines at all. So it's conceivable, we're nowhere near that yet, but it's conceivable that they move directly to renewable electricity production without transitioning through the burning of fossil fuel.
All right, well, I'll close it there. Thank you very, very much again, Graham and Guillaume, for agreeing to chat today, and thank you for everyone who's signed on. We got a great turnout and a great number of people registering, and I think it's a little bit I guess promising that we can still do events online, and Zoom does actually work. But yeah, I'd like to say thank you again, and hope the rest of COVID treats you too well.
Good. Okay.
Well, thank you again for visiting that. Nice meeting you all. Nice meeting you, Graham. And
Yes, and likewise, thank you. A great opportunity, and all the best for all of the students as you try to decide where you'll start your careers.
Yeah, you've got 3 options now.
We'll see you guys on campus in semester 2, I hope.
Yes, I hope so. All right. Well, I'll close it then. Thank you again, and see you around.
No worries.
Thank you. Thanks. Bye-bye.